Let's get your trading week started. Live from New York City this morning. Good morning, good morning. Equities high, a 5-day winning streak. Can this become 6? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming off the back of the best week of gains this year. Equities inspired by a major bond market reversal as incoming data clips the wings of central bank hawks. We begin with the big issue, the bulls. Catch a break.
We have seen a rally in both equity markets and the bond markets.
Kind of a relief rally after such a dismal couple months.
There's a bit more reason for investors to be a bit more optimistic.
Now we know that major central banks are on hold.
The Fed was probably done with rate hikes.
The payrolls report was picture perfect.
Just confirmation as to why the Fed should be done.
You couple that with the announcements that we got from the Treasury.
The markets are just taking off.
We do have a recipe for a pause, if not a further fall in yields.
We expect the market to continue to rally into year end.
We should still be prepared for a larger pullback or mild recession coming.
There is space for negative surprises in the earnings picture for next year.
If the economy proves to be more resilient, if inflation proves to be more stubborn, the bond yields could go up once again.
It's not going to be a straight line for the stock market or rates after this big move.
There are still risks and problems ahead.
Joining us now to discuss, Citigroup's Stuart Kaiser, Tony Dwyer of Canaccord Genuity. Tony, it's been a morning full of happy talk. This from HSBC. Goldilocks is back. We are pro-risk. Tony, have you changed your view on this market?
John, as you know, I haven't changed all year. I don't expect change now. I'm in the recession camp. I don't think there's anything that's refuted that. What you just had is, we're always so great at being right in hindsight. But, what we had coming into last week was really a historic oversold condition using one of our favorite indicators, the weekly stochastic. And then you couple that with a bond market that had 3 identifiable catalysts, and you get a counter trend rally, which is quite frequent when you're in a broad bear market.
Stuart, beyond positioning, what did I learn last week?
I think you got confirmation from the Fed that they're on hold, and you got more information that the labor economy and services spending remain strong. And then thirdly, I think you got a nod from the Treasury that they're respectful of what's going on in bond markets, and they're going to try to manage that risk as best they can.
Sounds like you think, Stuart, this can continue. Is that right?
100%. Yeah, we do think the market's going to move higher into year end. That's been our view for the last couple of weeks. The bear case has been a little bit of a whack-a-mole. People tell us data's too strong, you can't be bullish. Data's too weak, you can't be bullish. The fact is the underlying U.S. economic data remains strong. As a simple rule of thumb, I think as long as U.S. labor market and services spending holds in, you can run long equity risk. If that comes under pressure, then you want to get out quick, and you want to be very cautious about when to re-enter.
Tony, what do you say back to that?
Well, I agree. Historically, when you have a weak or a negative August, September, October, you have an up end of the year, November, December. Our case is just that last week was so vibrant. We had put out the call for a rally that it pulled forward a lot of what might have happened later in the year. So I agree with Stuart. I could see it grinding higher a little bit going into year end. But I think ultimately you need a lot more. And Stuart and I have different frameworks, right? I can't get a long only institution that trades for 3 years out quickly. His client base and some of ours can. So what I've got to do is try and position what's the fundamental backdrop on top of the tactical backdrop. And it was very good to see a drop in yields. And so many are focused on whether the Fed is, just when they're done or not. And you hearken back to banks and small caps and home builders had the best week since April of 2020. Remember what was going on in April in 2020? The Fed had announced that they were going to buy high yield debt. We're just trying to figure out if they're done yet. I think they're 100 basis points overdone. And it's a foregone conclusion, which means ultimately, after we get this relief rally, which we're in the midst of, I think bad news has to be priced as bad news if you go into that recession environment.
Tony, recency bias was a phrase that was thrown at me a few times already this morning, just extrapolating out last week's price action. Feels like we're doing that from week to week. Let's just sit on the bond market for a while. 2 weeks ago, we had yields through 5% on a 10-year yield, cycle highs. This morning, we've got a 10-year back to about 460, break of that level in the last couple of sessions. Tony, is there reason to believe that the highs of a few weeks ago were the highs?
Yeah, I think it's likely that they could be the high. Whether it is or not, and you go back and test, it doesn't matter. Let's put it in perspective to everybody watching. What typically kickstarts economic activity? Why does the market make a low in a recession? Because there's an improved outlook for money. Rates come down far enough that you can kickstart a refi cycle. 82% of mortgages, 30-year conventional mortgages, are below 5%. Buddy, that's almost 300 basis points below today. So the point that you had a 60 basis point or 40 basis point, that is fantastic. And that was the catalyst for the oversold rally to really kickstart a fundamental improvement in the mortgage market that allows for an improved outlook for money over the longer term. You need a dramatic drop. And the tone that the Fed had coming out of, the 2020 debacle, where stocks acted in a kind of similar way, was very different than it is today.
Well, let's talk about the tone of the Fed last week, more recently. The pushback that we're expecting this week, Barclays specifically. This is what the team over at Evercore have to say as well. You've got Barclays looking for one more hike, but in January 2024, they're pushing it out. They see this as very, very circular. Evercore said this morning. We expect Fed speakers this week will try to lean against any continuation of the rapid retreat in yields and easing of financial conditions late last week, triggered by the Treasury funding announcement, the November FOMC meeting, and labour market data that ease fears of overheating. Over at Barclays, this similar view that maybe this has become quite circular and perhaps this Federal Reserve has to push back to what we heard and what we saw in response to what we heard, Stuart, last week. What's your thoughts on that, Stuart? The Federal Reserve almost endorsing tighter financial conditions, doing some of the work for them, and then unwinding those tighter financial conditions in the space of a few trading days.
Look, I think this is the downside to try to target market-based financial conditions, right? You end up chasing your tail a little bit, and it's very hard to kind of thread the needle on communication. So, communication is a policy tool for them, and it's sometimes effective. And I think when it is effective, sometimes it can overshoot, and they ultimately have to then go back the other way. So, look, I think when you have a Fed that doesn't have as much confidence in its forecasting ability as it used to, and a market that's a little skeptical of their forecasting as well, you're basically chasing the market, and you're going to get a lot of ups and downs. And to your point, week to week, it's a different story.
It's a different story last week compared to the week before. Is it going to be a different story this week? Mike McKee, we've got data, we've got Fed speak, and I believe we've got some Treasury supply as well through the week.
Probably not going to have a different story, though, John. The plot changes a little bit, the characters change a little bit, but the novel remains the same. Let's look at what's happened. You guys have been talking about it this morning. This is the last month for the 10-year note yield. Remember, we got to that high, and everybody said the world was coming to an end because the Fed was now going to have to respond to the market, and then we had the supply last week, followed by the Fed doing nothing, and then the jobs report, and now, of course, the world's coming to an end again. What's going to change that? I don't know. We do have a lot of supply. You mentioned that. Someone has to buy $330 billion worth of treasuries this week, and $40 billion approximately in corporates. We'll see what the price is. I mean, it'll all get absorbed, but what is the cost and how high will interest rates have to go? Maybe that does make somebody think a little differently. Fed calendar, very, very busy. We've got 11 Fed speakers, 17 speeches, and almost none of it is going to matter because the Fed doesn't meet for another 6 weeks. So what they say this week doesn't matter all that much. A couple of interesting ones, though. Jeffrey Schmidt, the new Kansas City Fed president, makes his first speech. Jay Powell on Thursday, everybody's going to listen to. And then Ms. Pease, the acting president of the St. Louis Fed, is giving a monetary policy speech. That's very, very unusual for an acting president. They're still looking for someone to replace Jim Bullard. So it'll be interesting to see what she has to say. But since she's speaking right before Jay Powell, I don't think it's going to have a lot of market impact, which gets us back to my theme. The week's not going to change a whole lot because we're 6 weeks out from the Fed. The market replaces John minute by minute, and the Fed does every 6 weeks.
And Mike, you know the game we'll play in between, don't you? We'll do this for the next 6 weeks, no doubt about it. Mike McKee, thank you. The line from Barclays, the dovish turn may have backfired. Tony Dwyer, has the dovish turn backfired already, given the moves we've seen in equities, in bonds, in credit?
John, the insanity of what we're doing to your point earlier, is chasing our tail every time there's a market movement. How many times over the last 2 years have we heard the market's breaking out, and anytime it's done this, it's been a new bull market, only to find out it's breaking down, and anytime you've done that, it's a new bear market? And those typically are the extremes. I just believe that the economic data doesn't turn that quickly. Now, the problem that the Fed has that very few people know about is it's called the survey initiation rate. It's how many companies and individuals respond quickly to the survey from the government that they use for the data. And post-pandemic, it has been extraordinarily low. That is why we're getting the kind of revisions in the labor data that we get. I mean, think about the fact that the government gets our data on income spending and the unemployment rate in the household survey done by the Census Bureau. They still survey us by knocking on our door and calling our landline. John, do you have a landline?
I don't have a landline, Tony. I'm not sure the last time I had a landline. Tony, I'm with you.
I mean, the point is, I trust the trend of the data, not the data. And anytime that you've had this kind of a rise in the unemployment rate from the cycle peak, it's a heads up that we're weakening. And almost all the bullish scenario, and by the way, I'm closer to being bullish than bearish because we're closer to bad news being priced as bad news.
Sure.
But it's all based on a strong consumer based on high employment. What if that changes and has already changed?
Tony, I'm with you. The price action writes narratives. It's always the way. And when you see big moves like what we saw last week, people are going to ask, has something changed? So let's go through the moves. 6% move, there and thereabouts on the S&P 500. 6.5 on the NASDAQ 100. Big move lower in bond yields, 2-year, 10-year, 30-year, right the way through the curve. Stuart, we need to go back to where we started this conversation. Stuart, did something change last week? Let's put the price action to one side. Did we learn something new? And Stuart, for what I get from you, you think we did?
I mean, I don't think you learned anything completely new. I think you got, some things that were uncertainties kind of crystallized a little bit. I mean, last week was very much a risk-on, low-quality rally. Our short interest stocks were up 18% week on week. So you definitely had folks that were kind of forced back in to cover some stuff that they had been short. That suggests that they were surprised either by the incoming data or by the tone of the Fed. And that's kind of what drove markets last week. This week, we think it'll calm down a little bit. Typically, those positioning type moves tend to burn themselves out relatively quickly. And I think, to Mike's point before, I mean, you have a little bit of a dearth of data this week. So it's going to be a real test of, do you need macro data to push the market higher, or in kind of a data vacuum, will positioning momentum, kind of continue to rule out? Early this morning, it seems like momentum will work, and that's what we expect. But it's going to be a big test for the markets with not much data this week other than claims and some Treasury auctions.
And Stuart, I'll throw in another one as well. A lower bond yield sufficient for a rally, regardless of why bond yields are lower? Now, Stuart, the reason I bring that up, as you know, because you've said all year, basically, that this is a rally built on good economic data. And good news is good news, and bad news is not going to be good for this market. Stuart, can you tell me, is that still the case from your perspective?
Yeah, it definitely is still the case. And I think one thing to respect, too, on the positioning side, as much as people might have been short equities, they were short bonds as well, right? So you have this move in yields, and you also force people, particularly systematic buyers, back into the bond market. So that can kind of, create a little bit of an overshoot on yields. But look, from my perspective, yeah, good news is still good news. If you took out the strike impact, you printed 185,000 jobs last week, following up on almost 300,000 on a revised basis, the previous month. So in our view, some of the forward-leaning indicators like credit card spending look a little weak, but, the reported economic data from the government, still looks solid. And until that's not the case, yeah, we do think good news is good news and the market can move higher.
We'll continue this conversation. Stuart Kaiser, Tony Dwyer going to stick with us. Some different views there, some nuanced views on where we're going next in this market. We still need to talk about this massive run we've seen for the bank stocks. Last week, KBW Bank Index up 11%. We'll get to that conversation in a moment. Futures right now positive 0.2% with some movers going into the open. Here's Abby.
John, well, we have had some breaking news over the last 10 minutes or so. Let's take a look at the shares of PepsiCo and Disney. PepsiCo, that stock is down about 1%. Their long-term CFO, Hugh Johnston, is leaving the company for Disney after 34 years, 13 years as CFO. He'll be leaving on November 30th, starting at Disney on December 4th, and he will be receiving a one-time $3 million signing bonus. James Caulfield at PepsiCo has been named named as the new CFO at PepsiCo. Berkshire Hathaway up about 0.7%. They put up $93.2 billion in revenue in their last quarter. That was a roughly 5% beat. Their cash pile grows, John. It is now a record $157 billion. Some might say that the recent selling in stocks, well, it hasn't been bad enough or fearful enough for Berkshire Hathaway to be greedy enough to start buying.
Abby, thank you. More on that around the opening bell. Coming up on this program, bank stocks recording their best week since 2020.
The banks can also rally into year end if we have this pause in yields and still constructive sentiment.
The financials looking for a 6th consecutive day of gains. That conversation up next.
My concern about the banking sector is that I do think 2024 is going to be a harder year from the perspective of the economy, and especially from the perspective of charge-offs, delinquencies, bankruptcies, and defaults. And if you think about what one sector is most likely to feel all of that, whether it's defaults in commercial real estate, whether it's bankruptcy filings, whether it's consumers defaulting on perhaps their credit cards, I think it goes all right back to the banking sector.
U.S. bank stocks recording their biggest weekly advance since 2020, rebounding from their lowest level in 3 years on growing hopes that the Fed is done raising interest rates. Analysts at KBW upgrading Bank of America this morning, citing the recent decline in long-term rates following the better-than-expected productivity report and weaker-than-expected jobs report. Shani Basak has more. Hey, Shanali.
Good morning, John. You're looking at the regional banks starting to also bounce back on the heels of not just this idea that you have the yields overall starting to cool to a bit. You also have this idea of the yield curve facing a lot less pressure than it had been earlier this year. So, for example, even in the 230s curves, you've seen moments of disinversion earlier this month as you look to the picture for the banks getting a little better. Now, some of the worst badly beaten of banks here are still down quite significantly. Take First Horizon Corp, still down more than 50%. KeyCorp still down more than 34%. KeyCorp is one of those banks that Bill Gross has recently said he's bought into, along with Citizens Financial, Truist, KeyCorp, some of the bigger of the regional banks here. I've got to say, when I talk to my sources across Wall Street, it's not just the stocks that they're looking to buy at a bottom here, because remember, we did see a bigger sell-off in the KBW than we did even in March in terms of retesting new lows. In the last week, we have hopped 11% higher on that KBW Bank Index. We're still off by 30% from the highs of this year, and the worst of the worst banks are significantly beaten down further than this. People are starting to buy not just the stocks, but also the bonds. For example, that KeyCorp story that I was telling you about, you had them trading at less than 90 cents on the dollar, certain bonds of KeyCorp, now back up to 93 cents. So the picture is looking like it's starting to improve. That is contingent on the credit quality of these banks in terms of their loan books also staying healthy throughout the remainder of next year.
Shanali, thank you. Just a massive week of gains for the financials on the S&P 500, the bank specifically last week. Back with us for a final word, Stuart Kaiser, Tony Dwyer. Stuart, you put out the note over the weekend, upside ideas for a data vacuum. Are the financials one of those upside ideas?
Financials are not one of those upside ideas, Jonathan. Unfortunately, I wish we had gotten that right last week. But look, I think for the financials, you need to split the regionals out from the large caps. But if you look at large cap earnings, they did highlight held to maturity losses and higher deposit costs, which have obviously a negative read through down to the regional side. You also have a deal calendar which hasn't been, kind of as robust as you would like, and you have the threat of large capital requirements. So, the banks kind of don't fall into that category. From our perspective, you want to be trading, kind of upside into year-ended equities, via tech and momentum. So that'd be Q's upside is probably the default, or maybe some call options in the bond market as well. But we've got a long list if you want all of them.
Give me all of them, Stuart. Give me three.
Give you three. Look, we like owning Q's upside, so 390 strikes on triple Qs. We like owning 90-95 call spreads on TLT, for a view that, if CTAs have to come in and buy bonds, you can get overshooting yields. And if you fully disagree with us, which means you're probably in the majority, then, I think you attack that through cyclicals. And that's just simple. I think you just go for IWM from that perspective. Russell 2000 is still net down year to date. So if you think you're going to get this sort of lower quality rally continuing into year end, that's the poster child for stuff that's lagged.
Let's get to the second piece, the bond call. Within that, what it means for the equity market. Tony, last week what we saw was lower yields benefit financials. Do banks need lower bond yields from here to perform into year end?
I don't think it was just the lower bond yields benefited the entire market, and anything that had been hit on higher bond yields, John. You can say the same thing about home builders, utilities, real estate. All of them had outsized rallies because they were down so much. I mean, banks, the KBW Bank Stock Index was down 51% going into the beginning of last week. How much do you think they're supposed to go down? So I think at this point, a lot of the negative influences are probably discounted, even in a recessionary environment, which means you're probably going to get some chop around lows. You know, lows or bottoms are made on time, not price. You can have a trading rally along the way. I looked, before I came on the show, I looked to see when the BKX had, which is KBW Bank Stock Index, has had a 10% or more than a 10% 10-day rate of change. In other words, over 2 weeks, they've gone up more than 10%. It's taken place 4 prior times this cycle by my eyeball. I didn't, map it out on Excel, which means that if you just made it low, those prior 4 times weren't the right buy. I think we're getting closer, but you really need to have those recessionary indicators come in so that the outlook for money can improve more than just the Fed may not raise rates again.
Tony, just to finish up, I get the sense from you that you just want to sit this out for a while and wait to see that deterioration come to the surface before you actually get involved in buying risk in any material way.
Well, we did last week for a little bit. The stage was set for a rally. But, yeah, we've been light and tight, John, for the better part of 2 years. And as you know, I'm kind of known as the perma bull, unless the outlook for money remains poor. And I think that is the case. Cash has outperformed over the last 2 years. There's no need, in our view, to take a major bet. I don't like to guess with my money. I certainly don't like to guess with the viewers' money. And right now, nobody has any idea what the bond market's going to do. So we're in this sit and wait and be convinced, because that's what leads to conviction and the ability to really chase a rally or buy into a meaningful dip.
I have a great deal of respect for you both. You know that. Tony Dwyer, Stuart Kaiser, thank you, gents. Appreciate it as always. Going into the opening bell, coming up the morning calls and later. State Street's Laurie Heinel making a case for safety. That conversation still around the corner, about 7 minutes away. Your opening bell up shortly. Five-day winning streak on the S&P 500. Longest daily winning streak going back to June. Can we make it day 6? Futures just a little bit higher. That's the price action. Let's get you some morning calls. First up, KBW upgrading Bank of America to market perform, pointing to an attractive valuation and the recent decline in longer-term rates. Bank of America downgrading Paramount to underperform from a buy, cutting shares by 2 notches with limited asset sales on the horizon. And finally, Barclays upgrading Clorox to neutral, seeing a favourable setup for a meaningful earnings recovery. That stock is positive by around about 0.75% in early trading. Coming up, State Street's Laurie Heinel expecting geopolitical tensions to fuel a volatile year ahead for the equity market. That conversation up next. Your opening bell just around the corner. .25 seconds away from the opening bell this morning. Good morning. Coming off the back of the biggest week of gains of the year so far on the S&P 500. 5-day winning streak, looking to make it day 6. Your equity market positive here by 0.1% on the S&P. On the Nasdaq, up by 0.1% after a massive week of gains of more than 6% on the Nasdaq 100. There's your opening bell. Switch to the board and get to the bond market. Yields look like this. Last week, aggressively lower. This morning, higher by 5 basis points. Your 10-year, 4.62. 44. Last week lower on a 10-year by more than 26 basis points. On a 2-year lower by around 16. This morning, your 2-year, a break of 4.90. In the FX market, tons of dollar weakness last week. The euro against the dollar, that currency pair, the best week of gains going back to July. This morning, we add a little bit of weight to that rally. The euro back to about 107.42. And in the commodity market, 82 handle on crude, up by 1.9% on the session. 30 seconds into this session, the start of a brand new trading week. Your equity market positive by 0.25% on the S&P. On the Nasdaq, up by 1/3%. 2 names to watch at the open. PepsiCo's one, Disney the other. PepsiCo CFO Hugh Johnston leaving the company to become the CFO of Disney. Johnston writing this: "I'm grateful to everyone who I have worked with and for the trust which has been placed in me. PepsiCo will always be a very special place." Abby has more. Hey, Abby.
Hey, John. Well, that makes a lot of sense. He was there for 34 years as CFO for 13 years, so a real history with PepsiCo. And you, of course, have interviewed him a number of times. Great executive for sure. So lots of C-suite changes. So he is leaving PepsiCo for Disney. This change will happen. He'll be leaving PepsiCo on November 30th, starting at Disney on December 4th as their CFO. He will receive a one-time signing bonus. James Caulfield has been named as the new CFO at PepsiCo. The stock's not really reacting all that much. Where we are seeing more of a reaction, though, is another stock where there's been a C-suite change announced, and that is Bumble. Whitney Wolfe Herd will be stepping down from the company she founded nearly 10 years ago. The stock is paced heading toward its worst day since March of this year. Slack CEO Lydia Ann Jones will take over starting in January. Evercore ISI analysts are saying that they're incrementally negative on the news. They need to learn more. Well, the stock, John, it is down 80% or so from its IPO. So lots of work there to be done.
Abby, thank you. Lots of changes in the C-suite this morning. We'll talk about Dish with Simone Foxman a little bit later. We'll catch up with her in about 5 minutes' time. Let's turn to the auto space. Shares of Tesla moving higher for a 5th consecutive session, getting a boost from a Reuters report saying the company will manufacture a new €25,000 vehicle at its factory near Berlin. Katie Greifeld on top of this story. Hey, Katie.
Hey, John. Yeah, Tesla up about 2% on the moment on the heels of that report from Reuters that it will produce a €25,000 EV at its factory near Berlin. Now, for context, its current least expensive sedan retails for just under €43,000 in Germany. So this would be a dramatic step down in price. Now, according to Reuters CEO Elon Musk, he announced this plan to staff last week while visiting the factory. He didn't specify when production would actually start. And keep in mind, this is something that he's been teasing since at least 2018. But competition for affordable EU-made EVs is building. You take a look at Stellantis. They're taking reservations for a €23,300 model, while Volkswagen is planning its own sub-€25,000 model as well. Now Tesla reportedly throwing their hat in the ring. That's giving a slight boost to shares, on track for what would be a 5th day of gains, John.
5th day of gains there, Katie. Thank you for Tesla. 6th day of gains on the S&P 500 this morning. Just inching higher on the S&P about 3 minutes into the session by 0.2%. Elsewhere, Berkshire Hathaway reporting results over the weekend. The company's cash pile hitting a record $157 billion as a result of fewer deals and higher interest rates. The company writing this: "The amount of investment gains and losses in any given quarter is usually meaningless. That can be extremely misleading to investors." Shanali Basak has more. Hey, Shanali.
Hi, John. When you're looking at those investment losses, certainly they are stunning when you look at Berkshire's portfolio. Yes, they waver. But let's look at just Berkshire's biggest bets. And you are seeing the market reacting to Berkshire Hathaway now. You are seeing nearly, for the first 9 months of the year, $1 billion, nearly $1 billion worth of investment losses on Berkshire's portfolio. And you look at some of their biggest bets: Apple, even American Express, which was up in the quarter but muted in terms of gains from the prior quarter. Bank of America, the biggest stunner of them all in terms of how poorly they've performed this year, all facing a lot of pressure this year and therefore also weighing on Berkshire's portfolio. Now, that $157 billion in cash on Berkshire's portfolio helps them in some ways because, of course, cash means more today than it did a year ago. And if you look at their insurance segments here, you're also seeing them raking in investment income on the back of higher yields. But the yields, of course, are not quite compensating enough for the market, as you're seeing in terms of the pains they're seeing in their investment portfolio. Even some of the operating segments, which are up quite meaningfully, we'll point to one in particular here, which is BNSF, which saw profit fall because of the weight of inflation and lower volumes. And so, of course, big economically sensitive stock. This is a bellwether to the American economy in some ways. Those types of signs are where you see a little concern.
Shanali, thanks for the update. Berkshire Hathaway there, just a little bit negative, down by 0.1%. Back to some more changes in the C-suite. Dish announcing its CEO is stepping down. The company writing in a statement, Erik Carlson intends to resign on November 12th. He will remain on the board of directors through the closing of the merger between Dish and EchoStar. Simone Foxman has this. Hey, Simone.
Hey, John. Yeah, this really seems to be relating to that pre-announced merger. Hamid Akhavan, the CEO of EchoStar, will become president and CEO as Carlson steps down. I think what analysts, though, are reacting to this morning and why we're seeing shares now down over 15% are some of the really terrible numbers that we got from Dish in their earnings announcement. Analysts were actually expecting a profit of 6 cents a share in the third quarter. Instead, they got a loss of 26 cents a share. Third quarter revenue missing estimates down about 10% year on year, and the company lost more subscribers than they expected across pay TV and wireless, losing, in fact, 225,000 mobile users. That's more than 4 times the loss that analysts had anticipated. The company also announcing that it was selling some spectrum assets and about 120,000 prepaid subscribers in Puerto Rico and the U.S. Virgin Islands. Dish says it's going to use the money, $256 million, to boost its capital for the U.S. business. But Citi says this wireless performance is really a concern for the broader 5G wireless strategy. And analysts there believe the post-merger company will still likely need to raise external help beyond 2024 to meet upcoming funding needs and maturities. They're looking for more information at the call at noon in New York time. We're already trading around 1998 levels and shares down over 16% now today, down 67% year to date, John.
Simone, thank you. That name this morning getting absolutely hammered. In the last week, this equity market moving in the other direction. We're about 6 minutes into the session. 6th day of gains on the S&P 500, positive here by 0.2%, adding a little bit more weight to the rally we saw last week. Again on the S&P, biggest weekly gain of the year so far, a gain of 5.85%. Last week yields lower. This morning yields a little bit higher. Look out for the supply on both the credit side and the Treasury side through the week and a week ahead. The 2-year right now up 6 basis points to about 490. 10-year maturity up 5 to about 462. Bear in mind where we were 2 Mondays ago. 2 weeks ago, we had a yield through 5% on a 10-year, aggressively lower over the last week. Here's the slate of supply to look out for. Mike McKee mentioned it a little bit earlier. Just bringing up the numbers on the Bloomberg. $48 billion of 3-year notes coming up a little bit later this week. Then it's on to $40 billion of 10-year notes and $24 billion in 30-year bonds. That's a lot of supply following a big week of gains for the Treasury market, rallying, yields lower. Let's see what that kind of action provided by those bond market supply that we get later this week. It's going to be amazing to see. State Street's Laurie Hartnell discussing her outlook for the year ahead, writing this. Our highest conviction idea for 2024 is long duration US rates. We continue to hold elevated levels of cash, but we'll soon to deploy that cash opportunistically. I'll get my words out, Laurie. Forgive me, I've lost my voice over the last week. Laurie, let's start there. We've got $5 trillion plus of cash sitting in money market funds in America. Laurie, what's going to unlock that cash?
Well, first of all, what's going to unlock that cash is certainty that the Fed is more or less done. And we've gotten some early signs that perhaps the rate hiking cycle has ended and the next move will be lower. So being confident that rates are not going to go much higher, that they're actually going to go lower. But the other thing is going to be that we're actually navigating a soft landing, because there, again, for investors to get a bit more willing to put some trades on and actually take on some risk, they have to be more confident that this soft landing has actually been engineered.
Laurie, do you think we've got that stability in that bond market, given the moves we've seen? Last week, I get it, yields were lower, but can you make the call that the bonds are stable with moves like the ones we saw last week?
Well, volatility is going to be the key throughout most of 24 in our view. But we do think that at these yield levels, long duration treasuries still look pretty attractive. Certainly the move has taken a little bit of that opportunity away from us. But we think that going into 2024, if U.S. sees a growth rate of somewhere around 2% or so, it's likely that bond yields will continue to come down. So our highest conviction trade for those who are looking for more opportunistic investments is to go long duration treasuries.
What does that mean for the equity market call, Laurie, as you take on more duration and fixed income? Where does it leave stocks?
Well, we think stocks do okay in 2024, but it's going to be a bit of a transition year because, again, it's hard to envisage that the earnings will keep pace with where a lot of the forecasts are right now. There still will be, we think, some pressures in terms of growth sort of abating. We think that there will be still some inflationary pressures that will flow through, and some of the wage gains will start to flow through. So we think equities do okay in 2024, but we think the big move is going to be in bonds.
Is there a slice of the equity market that you prefer, Laurie, that you'd advocate for over something else?
Yeah, well, we're looking for those places where there's, pretty good risk reward. So we still like quality balance sheets, so companies that don't have to refinance in 24, 25, 26. We still like those companies that are a little bit more geared to those tailwinds, so companies that will benefit from the Inflation Reduction Act and the CHIPS Act, and those places that are much more durable, think consumer staples.
Where do the banks fit into this, Laurie? We touched on this with Stuart Kaiser and Tony Dwyer a little bit early this morning. We've just had a massive week of gains for financials. KBW Bank Index up by something like 11%. That weekly gain off the back of the bond market rally we saw last week as well. Do we need bonds to rally for bank stocks to outperform?
We don't necessarily need bonds to rally for bank stocks to outperform, but we need a little bit more certainty that we're not going to have a recession, right? So banks do well when there's still expansion, when there's credit demand. So a little bit of that would be healthy for banks. Valuations are pretty attractive, and as we continue to get kind of past these concerns about capital, we think banks could do better from here.
Laurie, thanks for the update. As always, Laurie Heinel there of State Street on this equity market. Gains this morning, about 11 minutes into the session, up by 0.2%. Coming up, the U.S. continuing diplomatic efforts in the Middle East.
We're working, as I said, very aggressively on getting more humanitarian assistance into Gaza, and we have very concrete ways of doing that. And I think you'll see in the days ahead that assistance can expand in significant ways.
That conversation up next.
One of the common denominators that I've heard throughout this trip is the imperative of American engagement, American leadership. Every country I talk to is looking for us to play a leading role with our diplomacy to try to make progress on all of these different aspects of the crisis. We're working, as I said, very aggressively on getting more humanitarian assistance into Gaza, and we have very concrete ways of doing that. And I think you'll see in the days ahead that assistance can expand in significant ways.
Secretary of State Antony Blinken arriving in Turkey after unexpected visits to the West Bank and Iraq. Diplomacy efforts continuing with stops in Japan, South Korea and India as the administration looks to refocus some of the attention on China. This is Secretary Yellen and her Chinese counterpart prepare for 2 days of talks on Thursday, with Biden and Xi meeting days later in San Francisco. Anne-Marie joins us now for more. Morning, Anne-Marie.
Good morning, John. Well, foreign policy is absolutely dominating the Biden administration. Over the weekend, we saw more frenetic diplomacy with Secretary of State Antony Blinken in the region, in Israel and in other Gulf states, making the surprise stop as well, speaking with Mahmoud Abbas in the West Bank, in Iraq and in Turkey. On top of that, Jonathan, Bill Burns, the head of the CIA, is also in Israel today and is going to be traveling throughout the region. So clearly what you see from this administration is, one, they want to make sure humanitarian aid is getting into Gaza, and at the same time, they also want to make sure that this conflict is not spread throughout the region. And when it comes to foreign policy, and you're talking about this sit-down between President Biden and Xi Jinping, well, China and the United States have taken the opposite ends of these conflicts, whether it be Israel and Hamas, which Hamas is backed by Iran, or Russia and Ukraine. So this will be top of mind. But when it comes to Secretary Yellen, she's going to be sitting down with her counterpart, Jonathan. And for her, it's all about the economy. Writing an opinion piece this morning in the Washington Post, listen to what she had to say. This week, I will speak to my counterpart about our serious concerns with Beijing's unfair economic practices, including its large-scale use of non-market tools, its barriers to market access, and its coercive actions against U.S. firms in China, Jonathan.
Anne-Marie, let's put two stories together. There were some big protests over the weekend in the nation's capital. I want you to try and put that together with one poll we saw from New York Times, Siena College, with the former President Donald Trump leading in 5 critical swing states against the current President, Joe Biden. What's the pressure like within his party to take a different path?
Well, the pressure is palpable, Jonathan. When I walked into the White House this morning, what you see outside the White House concrete is handprints of blood. And what they are calling for, these protesters, is a ceasefire immediately in Gaza. Now, there are some protesters, Jonathan, who are calling for a ceasefire because they want to stop the bloodshed. They don't want to see, no one wants to see innocent civilian lives in the Palestinian territory of Gaza lost. At the same time, though, Jonathan, this administration wants to make sure that they are supporting Israel as they defend themselves from Hamas after that horrific massacre on October 7th. What you're seeing in these polls, Jonathan, though, is in these swing states, Like the New York Times Siena poll, similar to Bloomberg's News' poll with Morning Consult, the former president is winning when it comes to things like national security and the economy.
Kelly Lyons is going to join us right now to talk about this. AMH, thank you, down in Washington. Kelly, let's cross over to you. We've got another debate for GOP candidates a little bit later this week. The Republican Party is going to take the focus on that front. Do we have to start thinking about a different candidate for the Democratic Party as well?
Well, there are some who are calling for that now on the Democratic side in light of the poll that you and Anne-Marie were just discussing. In 5 of these states, it is Trump that is leading Biden, and Biden is really struggling with key groups of voters, Hispanics, blacks, and voters under 30, not seeing the same support he did in 2020. And that's definitely a very troubling sign in the Democratic camp, assuming that it is former President Donald Trump who would be the nominee competing with Biden in the general election. We still have a ways to go to actually get to that point, though. There is still a primary race that is happening. And to your point, John, those primary candidates, Donald Trump aside, he will once again be counter-programming the third primary debate in Florida, will be on the stage in Miami. Nikki Haley, Vivek Ramaswamy, Chris Christie, Senator Tim Scott, and Governor Ron DeSantis. You can expect that the conflict between Israel and Hamas will feature quite heavily in this debate, and Nikki Haley, whose campaign has built a great deal of momentum over the course of the last several weeks, is likely to flex her foreign policy experience, given she is a former ambassador to the UN, not just the former governor of South Carolina. But Ron DeSantis is going to go into this with a little bit of momentum of his own. According to Bloomberg's reporting tonight, the governor of Iowa, Kim Reynolds, is set to endorse Ron DeSantis in a critical state. Of course, this is where the caucuses will begin just about 2 months from now on January 15th. And it's a state in which Ron DeSantis has really been struggling. He's seen his poll slipping pretty much everywhere, but in Iowa specifically, he has a 27-point gap to close between him and former President Trump, who remains the frontrunner. And also importantly, in Iowa, a poll last week showed he is actually tied with Nikki Haley in that state at 16%. So we'll see if this pretty key endorsement is able to give him a little bit of a boost that his campaign, frankly, desperately needs.
And Nikki Haley with some real momentum over the last couple of weeks. Kelly, thank you for the update. About 20 minutes into the session, positive here by 0.1% on the S&P 500. Bit of calm after a monster week of gains on the S&P last week of close to 6%. On the Nasdaq, higher by more than 6% last week on the Nasdaq 100. This morning, the Nasdaq higher by, let's call it, 0.25%. In the bond market, mentioned this a few times already this morning, look out for the supply from the Treasury and also on the credit side throughout this week. Yields are higher on a 10-year by 6 basis points, 463. On a 2-year higher by 6 basis points, just short of 490. Further out down the back end of the curve on a 30-year yield higher by 4 basis points at 481. Let's get you some sector price action. Here's Abby.
Well, John, consistent with a very small gain for the S&P 500, not so much happening beneath the lid for sectors, but let's break it down because we do have a couple of sectors that are interesting. Real estate is the worst sector on the day, down 1%. This having to do with the fact that yields are higher, those dividends look less attractive. Industrials, materials, financials, energy also down. Then to the upside, it's an unusual mix. Tech up the most, up 0.5%. Then you have consumer discretionary, followed by the defensive sectors of utilities and healthcare. Let's take a look at that big bank rally that you have been talking about a few times this week. It really is pretty extraordinary over the last 6 days. And today we're actually down a little bit. But even so, over the last 6 days, there we have that the KBW Bank Index. And also if we were to take a look at the KRE, the regional banking ETF, up about 10% to 11%. The best stretch going back to June or July of this year, John.
Tech outperforming this morning. Abby there with an update on the banks just at the end after a stellar week of gains on a KBW Bank Index. Coming up on this program, the trading events you need to be watching, your trading diary. Coming up next.
Today, my outlook is that we're going to stay on that slow and steady. And if we continue to do that, then I think where we are now will be sufficiently restrictive to get us to the 2% level for inflation. But there's still a lot that's going to happen between now and even the next meeting.
Atlanta Fed President Raphael Bostic catching up with the brilliant Mike McKee at the end of last week. This Federal Reserve, in the eyes of many, sounds like it's done. Deutsche Bank, Brett Ryan, thinks this Fed is done. Rick Reeder on this program last Friday. BlackRock thinks this Fed is done. Citi, Andrew Honhorst also thinks this Fed might be done. Barclays out with a note earlier on this morning. This is getting some buzz that maybe this Fed is not done. that maybe they have to push back against some of the easing of financial conditions we've seen over the last week or so, and perhaps this Fed's going to start hiking again in early 2024. That's the call from Barclays this morning. If you are just tuning in this morning, good morning to you. About 25 minutes into the session, equities shaping up as follows on the S&P 500, higher for a 6th consecutive day, the longest winning streak on a daily basis going back to June of this year, following the biggest weekly gain on the S&P 500 of the year so far, adding just a little bit more weight to the S&P and the Nasdaq 100. That's the equity story. Here's the bond market price action: 2-year, 10-year, 30-year. Last week, the 10-year yield lower by more than 26 basis points. This morning, higher by 6 basis points. We're higher across the curve. 2s all the way out to 30s this morning. 2-year also higher by 6 basis points, reclaiming 490 on a 30-year, back to about 481. We talked about this a few times already this morning. Look out for it all through the week. Issuance, supply from Treasury, 3-year, 10-year, 30-year, all worth a little look through the week. That's the price action. Let's get you a sneak peek at the trading diary. Coming up through the week, Fed Governor Lisa Kirk speaking at 11 a.m. Eastern Time. Tuesday, more Fed speak. Schmidt, Waller, Williams, Logan and Barr. Plus the US kicking off Treasury issuance with a 3-year, $48 billion worth of issuance coming up on a 3-year maturity later this week. Wednesday, Disney reporting after the closing bell. More Fed speak with Cook, Barr, Jefferson and Chairman Powell, the headline of the week. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.